Canada's economy contracted in the first 2 quarters of this year. However, positive export and jobs data last week gave many analysts reason to believe the BOC would keep interest rates on hold today, which they did. Joining me on the line from CIBC World Markets in Toronto is Andrew Grantham. So was there any surprise there for you, Andrew?
Very little surprise, really, in the statement. It seemed very balanced. They pointed to some positive trends that are going on in the US economy, and they noted specifically that some of the strength in the US economy now is driven by sectors that are very important for Canadian exports. So they're touching on what we're seeing in the housing market in the US, and also in the US in terms of an uplift in consumer spending, which is very important for Canadian exports. But on the other hand, they also did point to the downside risks that we are seeing from China and emerging markets and the spillover impact that may have or is already having on exports and commodity prices. So it's a pretty balanced statement, and a statement that suggests that the Bank of Canada are very much on hold in terms of interest rates at the moment.
The central bank predicted in July that GDP would rebound in the third quarter to grow at an annualized pace of 1.5%. Do you share the same view, and what will be the main drivers for the economy going forward?
Well, I think if anything, the third quarter could even come in above their 1.5% previous expectation. We actually have a forecast of closer to 3% annualized growth for the third quarter. We have already seen from the June GDP figures that the second quarter ended on a pretty strong footing. And we are going to see some temporary factors boosting growth in the third quarter. We saw families with children, for example, got quite a big check for back payments from child credits. So that's going to boost incomes and possibly spending over that third quarter. And we also saw earlier in the year as well that there were quite a few instances of retooling shutdowns in the manufacturing sector, and that already seems to be coming back and seeing industrial production rise in June and also July as well, so that's carrying over to the third quarter. So in terms of the growth outlook for Canada, the third quarter isn't really the problem for us. It's kind of what happens after that. As I said, some of the factors why we're so positive in the third quarter could prove to be temporary, and the extent that the economy slows down again in the fourth quarter will really drive kind of where the Bank of Canada sets policy going forwards.
Has the Canadian dollar been affected at all ahead of the interest rate decision? And what is your outlook for the US dollar, Canadian dollar, over the next 3 months?
Well, the Canadian dollar, I think, strengthened a bit, at least straight after the statement today. There weren't, the market wasn't placing a particularly great odds of a rate cut either at this meeting or in the near future. But I think the reason the Canadian dollar strengthened a bit was that the fact that the statement did seem pretty balanced. So it does seem like the bank is on hold for a fair while now, at least maybe through until the early part of next year, until we start to see some of that fourth quarter data rolling in, which, as I said, I think is going to be the key. That doesn't necessarily mean that there isn't further downward pressure on the Canadian dollar in the near term, though. We do have, or we will maybe see, some broad-based US dollar strength if the Fed does hike interest rates, particularly if they do hike next week at the September meeting. But even if they start to move interest rates later in the year, that is going to boost the US dollar and see the Canadian dollar depreciate, at least against that US dollar counterpart. And then we do have some election uncertainty here in Canada coming up as well. The election that we have coming up in a month or just over a month's time does look like a pretty close call, and we've seen around the world that when elections are a close call, that does tend to be negative for the currency. We saw that earlier this year in terms of sterling with the UK elections, and that could weigh on the Canadian dollar later this year as well. So our forecast over the next 3 months is for USDCAD to rise to 136. So the other way around, that would be around a 74-cent Canadian dollar.
Well, thank you very much for your comments, Andrew. That is all for now, but do join us again tomorrow for more from the Dukas Copy TV team. Goodbye for now.